Live from Sydney, this is Inside with me, Heidi Stroud-Watts, where we dive deeper into the stories that matter with crucial context and sharp analysis. When investors brace for President Trump's imposition of tit-for-tat tariffs on all countries on Wednesday, the Nikkei 225 sinking to its lowest in more than 6 months, while Taiwan's benchmark is set for a correction. Goldman Sachs economists now expecting the Fed and the ECB to cut rates 3 times this year as the global trade war puts growth at risk. Meanwhile, China's factory activity continues to expand. According to the latest PMI data, that's good news for the world's second largest economy ahead of more tariffs. And all of this is putting the focus on bonds as a better bet than equities to ride out the storm. We'll be getting views from 2 CIOs this hour. Vanessa Xu from VS Partners joins us, along with Nick Ferres from Vantage. And let's get you straight to these markets, and it has been a broadly risk-off session as all of the uncertainties, not to mention some of the geopolitical volatility that's coming into play when it comes to oil markets, some of these concerns over potential more sanctions over Russia oil have kind of culminated in what we're seeing at the start of this week. Of course, investors really firmly focused on what to expect ahead of that April 2nd, as President Trump is calling it Liberation Day, with the imposition and more details when it comes to these reciprocal tariffs. We're seeing global stocks dropping for a 4th day ahead of that announcement of new tariffs, concerns about the broader economic impact globally of a new trade war. We are seeing really investors, money managers just sitting on the sidelines, no big positions being seen here. Really a lot of de-risking going on there as well. We are seeing pretty steep downside really across the board. We are also seeing that drop when it comes to Thai stocks, up by 1.7%. That market, of course, reopening after the Myanmar earthquake. There are, of course, ongoing concerns when it comes to the rescue and aid operations in Myanmar. A ceasefire has been declared there, which should assist somewhat. But for Thailand, there's also some concerns about from investors as well as the implications for visitors and tourism as well. Let's get more, though, on today's sell-off and the risk-off action that we're seeing. M-Life strategist Mark Cranfield is with us here. And, you know, Mark, throughout the course of course, the first few months we've seen of the Trump administration and the volatility so far, we've seen kind of that gradual return to a little bit more optimism from investors. Does it feel like reality is sinking in this week ahead of April 2nd?
They're certainly getting a bit of a shock here, and in a way, what we're seeing today is the worst of all possible messages, especially in the equity market. Typically, at the end of the month or even the end of the quarter, as it is today, you would expect at least a reasonable amount of window dressing. Fund managers who maybe missed out some of the equities would at least be showing that their books hold a reasonable amount. That is not the case today. We're just seeing outright selling across all the major markets which are open in Asia today. It's just endless selling of stocks. That is a very bleak signal for people in the rest of the world, not just in Asia, because Europeans will be coming in, they'll see this sea of red across Asia, and they will not be too happy with what they see. Of course, US equity futures are having a pretty bad day as well. So it's a clear signal that people are turning ultra defensive, and at the same time, you've got US Treasury yields coming down as well. As you mentioned earlier, there are some major houses looking for more rate cuts this year from the Fed, but it's likely going to be some time before we see that. The Federal Reserve has shown that they're pretty happy where they are, they're on hold, and they do have some concerns that stagflation features may come back into the economy in the near term. So then they're in no hurry, and yet markets are signaling to them they really need the rate cut straight away. So it's a pretty poor dynamic, and on top of that, you're seeing the US dollar lose ground as well. There's no haven bid here for the US dollar. So traders are really turning ultra defensive, and there's probably worse to come in the next couple of weeks.
Certainly is a haven bid when it comes to Treasuries, right? Is this sort of one of, other than gold, I guess, is this one of the standout plays to try and de-risk?
Yeah, usually US Treasuries will do extremely well when people are nervous about other assets. What's adding to this is the fact that you've got a situation where the US dollar was already under pressure. Now you're getting the yield curve steepening a bit because particularly the short-end Treasuries are very well bid. But if you look at the 2-year Treasury yield, it's well below 4% now. And it won't be too long before people are pricing in a Federal Reserve rate cut, maybe for as early as the very next meeting, although the Fed are likely to push back on that. Gold seems to be the one thing that everybody agrees on. Gold seems to be the only asset that people are pretty sure is going to withstand whatever comes down the line from this trade war that's probably going to get worse this week. the Treasury curve is going to get much more interesting, because if the Fed do push back, there's actually a risk that we go inverted, because the market will be pushing for more and more. They will see the data getting worse in the United States. They'll be pushing the curve down. And if the Fed holds their stance, then traders will take it into their own hands, and they will push long-term yields down below short-term yields. That isn't happening just yet. The curve is slightly steep at the moment, but that is definitely something that could play, as it did once we had the Russian invasion of Ukraine, and there was a lot of consequences across global markets. Eventually, we saw deep inversion of the Treasury curve. That could be back on the agenda this year. It's a very fluid situation, and nobody is going into the second quarter thinking that markets are going to be any easier than they were in the first quarter.
Mark, we're seeing the steep slump when it comes to Japanese shares. We're also watching China as well, with the PMI, at least the pre-tariff impact PMI coming in a little bit better than expected. For China, is it a diversify if you believe in the DeepSeek AI story?
There's certainly a lot of reasons building up here why China can outperform. Whether or not Chinese equities can actually turn green when the rest of the world is in the red, that's a tough bar to cross. But certainly on a relative basis, China can do very well here. You see all the things putting into play. Today, there was confirmation that the Chinese authorities are putting more money, more capital into the major banks in China. That's a very good thing. The banks have just had decent results. They reported last week. As you say, the DeepSeek AI story is gathering pace across various companies in China. There's clearly traction in that area. The yuan is also very stable. The authorities are doing a very good job of making sure there's little volatility in the currency. From a foreigner's point of view, China is starting to look like a decent alternative. Money clearly is going to leave the United States. They'll be looking for other places. Europe and China are two of the outstanding places. So certainly China can probably outperform other Asian markets, maybe even some of the global markets as well. Whether it can actually post seriously positive results is not going to be easy if you've got big markets like US crumbling and people very nervous about the whole situation.
Bloomberg Urban Life strategist Mark Cranfield there with the state of play. And let's get some more analysis now from Vanessa Xu, who's the co-founder and CIO at VS Partners Hong Kong. Vanessa, great to have you with us, particularly on a day like today. I mean, you say that the correction when it comes to the US, of course, the source of all the market woes at the moment has been long overdue. How bad does it get?
Well, I think we are just getting the appetizer of that. So it's difficult to say how bad it will be getting. I recall in year end, I was on the same show as to if the US equity correct 20%, I wouldn't be surprised that we are halfway there. I think the former years of the GDP growth number had baked in the hangover from the excessive fiscal spending and the excessive government jobs creations. So if now those fiscal spending are shrinking and those factors are being squeezed out of the GDP numbers, I think it's reasonable to expect on the headline numbers that a quote-unquote recession will be seen. But what's key is to look at the component of the GDP growth. I think the Trump administration, at least as stated by the Treasury president, is that to avoid the longer-term fatal problem in the U.S. economy of the public sector debt that squeeze out the private sector vibrant productivity. So that's the long-term gain if the policy are successful, but will induce some short-term pain, potentially very sharp corrections compounded by the valuation that is already very stretched and very rich by the year end. So more corrections to come.
You've talked about more corrections and sort of short-term impact but for the fabric of trade and sort of, the more geostrategic picture across Asia. How structural are the changes going to be, and which markets do you see as being the beneficiaries and the ones that are most at risk from a trade war?
I think on a relative basis, China, as it has the deepest and the largest domestic economy, is going to fare better than relatively other Asia export-oriented economy. As we can see from the market reactions today, there are many technical factors, but relatively China stood more steadily than Japan, Korea, and Taiwan, which are all very susceptible to the potential demand slowdown from the US as their most critical export market. And over the first round of the trade war, since 2018, many of the Chinese companies has gone through the toughest time as to number one, domestic demand came down, and they learned how to be the most efficient in terms of a capital structure and operations. And number two, trade war 1.0 at least taught them a hard lesson to learn how to globalize as fast as they can. And the companies who cannot do the above two have perhaps already gone out of the business. So the remainders now from China, the industrial sectors, as you see, for example, a couple of car companies reported blowout earnings, which means that they have picked up the above mentioned two fundamental strategic transition to be resilient. So I think based on that, the Chinese companies are gonna flare better. But it's again an active investors market. It takes a very sharp eyes to pick out the sectoral winners from each of the sectors that exhibited above characteristics I just mentioned. Plus, I think the Chinese government has implemented medium to long term policies to curb the downside of the systemic risk I also mentioned in the last show. Including putting the credit in capital sufficiencies, boosting that for the banks, including allowing the local government to refinance their debt, and including putting the social security safety net to the bottom layer of the population, etc. These measures will not be felt immediately by the market, but it provides a floor for the companies that are in the market to relatively outperform.
And some of those really go towards kind of building the necessary demographic structural reforms, right, going forward. But I do wonder when it comes to what really triggered the China enthusiasm, the DeepSeek AI tech revival, do you see further in that thematic, or is it going to broaden out into more of a fundamental recovery?
Oh, the DeepSeek phenomenon, I think, is a boost of the confidence and the animal spirit of the private sector entrepreneurs. I think that is a lot more important than DeepSeek as a AI company itself and AI as narrowly defined sector itself. I think what's vital for the economic recovery is the private sector confidence and entrepreneurs' ability and willingness to put in capex to take on credit to extend their productivity. I think we see some macro data, PMI, etc. The green shoots of stabilization is partly because of that. I have been recently traveling in China to meet various sectors, mostly manufacturers of entrepreneurs. I think they are now willing to expand on their capex, but interestingly, not only domestically, but because, as I mentioned before, they have globalizable technology. They have learned how to be competitive, not only domestically, but globally. At least regionally. So they are spending capex globally. Outside of China. So I think in a couple of years, maybe in 3 to 5, we will see a basket, clusters of manufacturing companies from China, but they have revenues from global markets as a meaningful share, if not as important as their domestic investments. So it's more of a GNP concept of looking at the Chinese economy, particularly the hard tech economy, rather than the GDP concept.
It's interesting because it sounds like you very much see Chinese equities and companies now as a powerful diversifier at the start of another global trade war. Do you see the risk, though, that Chinese assets can also be viewed through the prism of being, a way to express some of that US risk? Or do you think that risk is mitigated by, policies and incentives that the Chinese government can take?
Well, those are very valid concerns by global investors. We look at it from a different lens. If globally capital base becomes, for the long term, a lot more expensive, and physical assets and high quality manufacturing assets, including critical resources and critical minerals, are going to be the bedrock of national competitiveness, economic competitiveness, then everybody will opt for that. Particularly in the last 10 years, the winning formula of a portfolio was to buy, by internet technology, by software technology, which are in the intangible economy. Now that we are moving into the, winning formula of a tangible economy, is going to revenge. Therefore, Chinese manufacturing companies, not only they are Chinese companies, but they are high quality global physical assets in industrial space, and they have footprint globally, then they are worthy to be owned, not because they are Chinese stock, it's because they are high quality long-term cash flow generating physical assets together with critical minerals and critical resources. That's going to be perhaps one of the most critical portfolio construction for investors to be mindful of in the next decade.
Who benefits from this China story regionally, do you think?
Well, I think from the micro level, it's the companies who exhibited such trades, and we see, for example, placement deals that revitalized the Hong Kong market. BYD and Xiaomi both did large-scale financing deals through Hong Kong equity market to finance their global expansion. Obviously, those companies are taking advantage of that, and I think this year Hong Kong market will see more of competitive industrial companies come to the market either through primary or secondary financing to support their global expansion. That's at the first degree. And at the second degree, I think the emerging markets of where countries, of where these companies go, they will invest the capex, as I mentioned. Their capex are spent outside of China, and they go to, Central Asia, they go to Eastern Europe, they go to Africa, they go to Southeast Asia. So those countries that are receiving these FDIs from North Asia will benefit from the job creation, from consumption creation, and we are looking into that as well.
Vanessa, really great to have you with us today. Vanessa Xu, who's a co-founder and CIO at VS Partners Hong Kong. Still ahead this hour, President Trump says he's angry with Vladimir Putin and would consider secondary tariffs on Russian oil if a ceasefire with Ukraine can't be reached. We have more details up next.
I don't think he's going to go back in this world. I've known him for a long time. We've always gotten along well. He considers Zelensky not credible. He's supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that. But I think he's going to be good. And I certainly wouldn't want to put secondary tariffs on Russia, but if they were put on, it would not be very good for them.
President Trump there speaking to reporters about Russian President Vladimir Putin and his threat of secondary tariffs on buyers of Russian oil. For more, let's bring Bloomberg senior editor Derek Wallbank. And Derek, it's been a remarkable sort of couple of conversations that we've heard from President Trump, namely in that NBC interview where I think we've had sort of some of the most fiery language yet that we've heard from the president against Russia.
Yeah, I think that's right, Heidi. And look, Donald Trump has been very clear that he wants a deal made between Ukraine and Russia, and he wants a deal for peace, and he wants the fighting to stop now. Now, he's taken a certain amount of flack, particularly from the left, particularly from Europe, particularly from some voices in Ukraine, about how close he has come to Russia in pursuit of this goal. But make no mistake, there is a line there somewhere at which point Russia has to stop a lot of what it was doing, or what has been doing somewhat relentlessly. Now, if you take some of those arguments from those sides and extend them through, what happens in a certain amount of time, only Donald Trump knows how much time, but in a certain amount of time, if Russia doesn't actually go forward. And that's one of the things that Trump is starting to lay down a marker on, to suggest that he won't be able to continue unceasingly with allowing Russia to sort of go on and continue without actually coming to a point that it stops aggressions. At the same point, he also mentioned a little bit later in that conversation with reporters aboard Air Force One that he needs to make sure that Zelensky isn't coming out of the mineral resources deal that Trump very much wants to get on there. Had some harsh statements there too if Zelensky were to pull out of that. So it's very much a fluid situation. Trump is saying something like, "I'd like to not have to put more sanctions on Russia," but he's very much trying to make clear that he is willing to do so if he doesn't think that Russia, at some point in the future, if he comes to the belief that Russia is not playing straight on.
It's interesting he talked about all sanctions, because this idea of also secondary sanctions related to Venezuela that we heard last week, could it sort of a new popular, economic statecraft tactic or strategy that we're starting to see emerge?
Yeah, this is a tactic that I think everyone needs to sort of wake up to and understand how it works. The idea of secondary sanctions, as the Trump administration has put them out, is to have a sort of tariff-like response that kind of works like sanctions. You could have a tariff response that basically says, we're going to put this amount on top of anything else that exists as a sort of penalty for not doing whatever else may be there, right? So it's additional to anything else that may. Trump is talking about, he's talked about it with Venezuela. He's talking about it in some other contexts as well. This is a tactic that people do need to be aware of and do need to be pricing in terms of the threats. It's not a replacement, but it is additive. And I think that additive is something that bears particular mention.
Bloomberg senior editor Derek Wallbank, of course, all of this as we count down to that April 2nd or Liberation Day, as President Trump is framing it. But of course, a lot of nervousness across markets and no doubt global policymakers ahead of those reciprocal tariffs due to be announced on that day. Well, coming up, Vantage Point Asset Management joins us to talk about how these global markets are bracing for these incoming reciprocal tariffs from the United States. They are due this Wednesday. Much more ahead. This is Bloomberg. Welcome back. You're watching Insight. Take a look at one stock we're watching very keenly today. That's trading CK Hutchison in the Hong Kong session. This, as we've heard, that CK as well as BlackRock are said to have delayed signing the Panama deal. But of course, as the mulling of that potential deal and the delay continues, we're seeing that stock dropping by the most in nearly 2 weeks. Hong Kong billionaire owner Li Ka-shing considering delaying the signing of a controversial deal to sell his Panama Canal ports to a consortium, including BlackRock. We saw that decline of as much as 4.7% in the Monday session, the most since March 18th. Year to date, we're seeing that gain being pared back to 5.5% versus a broader benchmark Hang Seng Index's 16% rally. But of course, we are seeing that broader risk-off stock slump across the region today as investors are really sticking to the sidelines ahead of the April 2nd Trump tariff deadline there. But we are seeing that political pressure as well in this situation, with Beijing really ratcheting up the pressure and criticism of this transaction. Let's get a closer look at this potential delayed deal, I should say, for CK Hutchison, the wider implications when it comes to China port operators and their rivals. Let's bring in our conglomerates reporter Shirley Zhao in Hong Kong, along with a BI Asia Pacific infrastructure analyst Denise Wong. Shirley, I'll start off with you. So what do we know in terms of the goings-on, the latest of what we're expecting here?
Well, so a lot is going to happen or are expected to happen on April the 2nd. So CK Hutchison is actually expected to sign a definitive agreement on the Panama port sales with a consortium led by BlackRock by April the 2nd. But late last Friday, Hong Kong local media reported that CK Hutchison is not going to sign any agreement on the day. And we also learned from sources that CK Hutchison is not expected to sign any agreement on the day. But sources are telling us that the deal is not scrapped. Talks and works are still going on, and that they need more time to sort out formalities stuff such as due diligence. And pro-Beijing newspaper Da Gong Bao last Friday also reported that China's State Administration for Market Regulation is looking into the deal to protect market competition and public interests. So this would be the first time the Chinese government has actually come out and say, we are looking into this deal. So pressure is definitely building on CK Hutchison to change their mind or pull out of the deal.
Is there a timeline on this at all in terms of, how we can expect this to play out and implications for, I guess, future transactions that might be considered politically sensitive?
So the timetable right now is a bit fuzzy. Nobody has come out and said there is a timeline for this deal. And we note that April the 2nd is not a deadline, but it's a target that the parties are working towards. And now they just need more time to sort out due diligence and other stuff. So there isn't a clear timeline in terms of when the parties are expected to complete the deal. But we know that there is a 145-day period for due diligence to complete.
And Denise, in your report, you talk about how a potential hold-up in the port deal represents an opportunity or a window for CK's global rivals.
Yeah, so with the deal, we actually noticed that, a lot of countries, Panama has been facing a lot of pressure from the U.S., and I think this is partly speculated as partly as the reason that CK Hutchison is pushing ahead with the port deal. But with the scrutiny from China over this, that could actually cause more countries to avoid partnerships or keep the distance from Chinese port operators to avoid getting entangled in Sino-US tensions. So
what sort of impact do you see, Denise, when it comes... No, continue.
Yeah, sure. So for the foreign rivals, for example, APM Terminal, DP World, they have all been actually expanding overseas. In the past, they see very strong competition from Chinese companies who sometimes may actually pay higher for certain port deals or greenfield developments if they align with the China's port Belt and Road Initiative. If we are actually seeing less rivalries from these Chinese operators, Chinese state-owned companies in particular, then the overseas expansion could actually gain path for these global rivals.
Yeah, tell us about the implications, Denise, when it comes to the potential for M&A, for deals, when it comes to some of these other global players.
Yeah, so for this in this case, currently the Chinese operators actually dominate the global port industries. China Merchants Port and COSCO Shipping Port is the second and third largest terminal operator globally by throughput. But with this deal, if the deal actually goes through, then MSC and Global Infrastructure Partners and BlackRock will be tying up with MSC, and that could create one of the world's largest port network, and that is going to affect the network advantage of the Chinese global operator, potentially creating a better rivalry or more balanced competitive landscape.
Our Bloomberg Conglomerates reporter Shirley Zhao there, our BI Asia Pacific infrastructure analyst Denise Wong there, as we continue to see that decline for CK Hutchison in today's session, which of course it is a broadly market slump that we're seeing across the region at the moment, really picking up on the back of what a fourth day of declines when it comes to US stocks there as well. This is a picture as we look around the region. We're seeing that 2% decline now for the MSCI Asia Pacific, which is the lowest in about 3 weeks. In particular, the very, very steep declines that we see in Japan. Japanese shares just plunging there. In particular, the prospect of auto tariffs hitting a number of the Japanese exporter stocks as well. We're seeing the biggest intraday fall when it comes to the Nikkei 225 since September. The topics retreating by close to 4% there as well. So we've seen the Nikkei now decline more than 10% since the end of December. The topics down over 4%. There's a lot of trimming of exposure to sensitive Japanese equities ahead of those reciprocal tariffs expected on April 2nd. We're also seeing similar declines when it comes to the Korean markets as well on these concerns. That's been coupled also with the end of a 17-month ban on short selling as well. So that is expected to boost overall liquidity as well as the bid to be upgraded into developed status in the MSCI. But at the moment, it's really working against sentiment in today's session. So we're seeing broadly risk off a couple of sort of havens that we're seeing some sort of solace there, of course, Treasuries as well as regional sovereign bonds as well as gold continuing to see that gain. Let's bring in Nick Ferres, who's a founding partner and CIO at Vantage Asset Management. Nick, great to have you with us. And you take a look at the action today, and it feels like the sort of culmination of weeks and months of policy uncertainty and trade woes. Does it feel like it's sort of reality bites finally for investors?
Well, if you ask us to describe what we do in one line, it's take on the emotional sources of volatility in markets or the emotional overreaction, and it's felt pretty emotional, especially today. But our sense is that what the markets are experiencing is a reverse feedback loop. So it's the unwind of forever and ever policy. Scott Bessent, the Treasury Secretary, called it the detox. But it's basically the opposite of what we've experienced over the last decade or so, and especially since COVID.
Which I think goes to the point that is held by some, which is this is particularly when it comes to the US, a correction that needed to happen. The issue is the detox going to, bring about ultimately healthier fundamentals or opportunities, or is this de-risking just going to continue?
Our sense is that it's relatively well advanced, that we've had a pretty meaningful correction, especially in some of the mega cap tech stocks. I think that the context as well is not just the valuation coming into this episode, but also the crowding in beliefs and positioning. And so there's been a significant unwind of that as well, and hidden leverage as well in the form of levered exposure into stocks like Nvidia. And so you're seeing an unwind of that as well. And certainly this year so far, we've also seen a rotation as well away from US equities into European equities and into Chinese equities. So the most unloved markets are the ones that have been outperforming, at least in a relative sense, year to date.
Yeah, so let me go through a couple of those because I did want to ask you about Europe and China. With Europe, Goldman Sachs is now saying don't expect the level of international inflows that we've seen so far to really continue at this pace. Do you see still further potential for Europe? Is it sort of just driven by the German fiscal sort of story, or is there more fundamentals that we should be talking about?
Well, I think the irony of the Trump administration's policies is that they've gotten the Germans to spend, they've got the Europeans to start to contribute to NATO, increased defence spending. So ironically, you can argue that there's actually some positive elements of at least outcomes potentially of the approach of the administration. But those countries, German exporters, Japanese exporters, Korean exporters, are clearly levered to and exposed to global growth. And so if this episode leads to or contributes to a further global growth scare or growth shock, then those sorts of markets are vulnerable. And you can see a reversal of that European equity outperformance year to date, especially in those big global exporters.
And that takes me to China there as well, right? And I asked sort of a number of our guests this today because this is kind of the dichotomy, whether you see China as a great diversifier, as it often has been in times of a global sell-off, or do you see it as just, a particularly brutal way that US policy can be expressed?
I think it's correlations to move to one on a day like today, or pretty close to one, and I think we've seen that in terms of the price action. But we are still relatively bullish on China tech, where we've got a small position in the CSI 1000 as well, as a broad index exposure. But if we go back to China tech, it's been a relatively strong performer year to date. It has pulled back, but when we look at the basket of exposure that we have there, in our Asia tech exposure, which also includes Korea and Taiwan, and that's even been impacted even more on a day like today. But our China tech, for example, those companies are still trading at 9 to 11 times earnings. They are net cash on balance sheet, and they've got 30 or 25 to 30% EPS growth probably over the next 2 years. So we're actually pretty bullish on that. And days like today, when it feels very uncomfortable, are days that you should be scaling up your exposure to equities that have those sort of characteristics.
You've talked about that sort of tech basket. Have you adjusted that basket perhaps more in favour of China since we've had the DeepSeek kind of catalyst kick off all the enthusiasm?
It did. In fact, we were quite early on with this. We were non-consensus in that, this time last year, recall that many investors argued that China was uninvestable, some of the famous investment banks. And now that MSCI China is up, well, at least as at a couple of weeks ago, was up 40% over the past year, then the sell side has been upgrading the market, ironically. But, the good news is that a stock like Alibaba, even though it's up 50-odd% year to date, still only trades on 13 times earnings. Alibaba could still double from here and not be overly expensive. So we do see significant upside in that market.
How are you managing sort of central bank expectations, right? Obviously, we've got the RBA this week, but I suppose the bigger question is really what room, or flexibility the Fed needs to give itself this year.
Yeah, my sense is that the greater risk in the near term is a growth scare or a growth shock. So we don't necessarily see tariffs as inflationary as the consensus believes. My sense is that it was interesting that the Fed started to taper or dial back the quantitative tightening that they've been doing, the balance sheet runoff. Now, that's not the same thing as starting to expand the balance sheet again, but it is a movement in that direction. And that would be potentially positive for global liquidity. It might lead to a reversal in dollar strength, and it would be actually helpful for emerging markets.
Yeah, tell us about opportunities for emerging markets, because I think if you're reasonably constructive on China, classically that's been such a strong correlator to the rest of the EM basket. Perhaps that's faded in recent years, but is that still a strong enough anchor there?
Yeah, that's certainly our main sort of bullish market that we like. Although we have still been broadly selective within that. I mentioned that one of the reasons why we like the mega cap tech in China, the major tech companies or the platform stocks, is because they are more exposed to consumption. They are net cash on balance sheets, so they've got strong balance sheets, and they do have reasonable growth. Whereas we've basically been avoiding bottom fishing in areas like property or stuff that's sort of leveraged to the economy. The one area I mentioned is that we've recently put on a smaller position in CSI 1000. I think another market that we really like, and it has pulled back so far year to date, is Vietnam. Now, Vietnam is a frontier market. the exposure that we have in Vietnam is via a listed fund which is listed in London called Vietnam Holdings. The ticker, the Bloomberg ticker is VNH LN. But if you look at the basket of equity within their portfolio or within that basket, it trades on 11 times earnings, has 25% compound EPS growth. We're incredibly bullish on Vietnam and the ability of Vietnam to benefit from the episode that's going on currently, particularly as it relates to the trade war.
Do you have any exposure to India at all?
Actually, we've got zero to India. So that's interesting. For us, it was more of a valuation argument, and we really we stood aside from India for quite a period of time. The other area of concern for us with regard to India is the currency, and we just don't see the INR as a store of value.
We've sort of gone right around Asia in terms of your sort of basically mentality that when we're selling a sell-off like this, and maybe you just have to be brave and kind of add to allocations. But I do wonder, are you tweaking other allocations to other asset classes, sovereign bonds, treasuries, gold, or even higher levels of cash? Are any of those strategies kind of useful at the moment for you?
We've basically got very little in the way of fixed income. It's only about 3% of the portfolio. I can see a case or an argument that kind of the good quote unquote outcome for Treasury bonds is actually a recession. So it's if the administration is successful and there's a significant reduction in the fiscal impulse in the US that allows the long end yields to come down, that's the bullish case for long bonds. Gold, we haven't had any exposure directly, but we've had a basket of gold producers. The Australian producers, mainly because we're in this time zone, including Newmont. We have pared that exposure back into the rally. It's up over 50% since we put that exposure on in September last year. So it's mainly been around profit taking with regard to that. The gold producers have incredibly strong free cash flow and probably still have quite a bit of upside, especially if gold continues to rally.
Yeah, I'm glad you mentioned Australia. It is RBA week, and of course it is also coming up to a federal election as well. I do wonder if there's any space in your portfolio for a market like this, which has long been pretty expensive, very stable, perhaps not as exciting as some of its regional peers.
It's a defensive market within the region. That's absolutely right. And over the last 3 years, while we had a bear market in Asia Pacific and in EM more broadly, we did actually have an overweight to Australia relative to China and other markets that had been underperforming. We have reduced the exposure to Australia over the last couple of months. So it was one of our defensive, quote unquote, less exposed countries within the region. But we do see it's vulnerable in two ways. One, household leverage is very high. It's the highest in the developed world. And number two, the ability of the central bank, the RBA, to cut rates, I think, is constrained.
Nick, really great to have you with us today. Nick Ferres is a founding partner and CIO at Vantage Asset Management. Coming up, it's now a race against time to find survivors of the Myanmar earthquake. Almost 4 days since the disaster struck. We'll get an update next. This is Bloomberg. Rescuers in Myanmar are working frantically to find survivors 3 days after the country's biggest earthquake in a century. Let's get some more details now from Bloomberg editor Margot Towie, who joins us now from Bangkok. And Margot, we've also seen the Thai stock market coming online as well. There's understandably a lot of jitters and nerves, even where you are.
Yeah, that's going to take a while to calm down. I mean, you know, it's pretty much a random event, but understandably, people are literally shaken by it. With the market opening, the stock market opening, it's not as off as you would expect. It's down about 1%, which is pretty much in line with across the region. Construction materials are up, which reflects that people are going to have to fix stuff. And the builders are down, given that people are freaked out about condos, living in condos. So you saw that. I saw that on Friday afternoon as I walked home. That was the only way to get there, with a whole bunch of people who were sitting on the pavement with their suitcases and nowhere to go. It will take a little while. I imagine that there will be a hit to tourism. That's being predicted by government sources, and potentially, I think it's pretty much a short-term thing.
Perhaps not so much when it comes to Myanmar itself, right, where the effects, the rescue efforts, the damage and the death toll are all more devastating for a place that has already been devastated by other factors as well, including a civil war.
Absolutely. That's a different story altogether. The infrastructure is poor to start with. You don't have the piling that you see in Bangkok. You don't have the construction standards, and it's literally on the fault line. It runs right the way through the middle of the country. Rescuing people, obviously, 3 days later is going to be, is there anybody left to rescue? But even getting to those areas is problematic because of the lack of infrastructure and the damage that's been caused by the earthquake itself. So communications, whether it's telecommunications or transportation, is a nightmare.
Bloomberg editor Margot Towie there, as we continue to see those rescue efforts continuing, both with the major building that was hit in Thailand as well as in Myanmar. Take a look at how these relevant markets are trading at the moment. As Margot mentioned, we are seeing a downside, I should say, when it comes to trading entire stocks. It's not unexpected given the broader market sell-off that we're seeing ahead of the April 2nd Trump tariff deadline anyway. But some of those affected sectors, obviously we've spoken about construction, builders and the like, that is down by just about 1% when it comes to the benchmark at the moment. We're also seeing a bit of a move when it comes to the Thai baht, but it's interesting because most EM Asia currencies are actually posting some gains ahead of the rollout of those US tariffs, the reciprocal tariffs by President Trump on April 2nd. Perhaps that anchor being led by offshore yuan as well, with the PMI numbers out of China continuing to show expansion. Broadly, though, that equity slump and the risk-off sentiment continuing. A look at tomorrow's program. We'll be talking about global cybersecurity threats as well as the latest developments when it comes to cloud computing. That conversation exclusively with Akamai Technologies CEO Tom Leeton. That is it for Insight. Horizons Middle East and Africa is next.